Do you think that banks want you to have a good credit score? Because they do not. Why? Well, because the lower your score, the more money they make from you. The lower score means the higher interest rates you're going to have, the more fees, and the more profit for lenders. So that's why there's so many myths out there about credit scores, myths that actually keep people from improving their financial health. Today, we're going to shine a light on the lies that banks want you to believe about your credit score and what the truth really is. I'm Aaron Baker, co-owner and investment advisor with Wismar Financial, helping you build generational wealth. One of the most common misconceptions is that you have to carry a balance and pay interest to improve your credit score, when this is completely false. Credit scoring models like FICO and VantageScore look at whether you make on-time payments and how much of your available credit is used. They don't reward you for carrying a balance or paying interest. In fact, keeping a balance just means you're giving the bank free money in the form of interest payments. The truth is, you can use your card, pay it off in full every month, and build excellent credit while avoiding interest entirely. Many people avoid checking their own credit report because they think it will lower their score. That's another lie that banks don't mind circulating out there. But here's the truth with that one. Pulling your own credit is considered a soft inquiry and has zero impact on your score. Only the hard inquiries, like when you apply for a loan or credit card, only these ones affect your score, and even slightly, usually only by a few points. Regularly checking your credit report is actually one of the smartest things you can do. It helps you catch mistakes, fraud, or even identity theft early. And according to the FTC, about 1 in 5 people have an error on at least one of their credit reports, an error that could be seriously damaging their credit score. So don't be afraid to monitor your credit. Use free tools like the one from Experian. I use this one and it's actually fantastic. This will help you really stay on top of everything. Before we go on, if you are finding this helpful, please hit that like button and subscribe so you don't miss future financial insights. Lie number 3, closing old credit cards improves your score. This one catches a lot of people off guard because you should close your unused credit cards, right? No, you should actually work really hard to keep banks from closing your unused cards. You might think closing unused credit cards is responsible, but it can actually really hurt your credit score, and here's why. It's all based off your credit utilization ratio. So closing a card reduces your total available credit, and this in turn can increase your utilization percentage. Higher utilization lowers your score. On top of this, you can also lose all the years of credit history you've built up. This has actually impacted me recently. One of the credit cards I opened up when I was a young kid, when I was 16, I co-signed it with my dad. My dad did this for the exact reason of helping me build credit starting at that age. I don't use it anymore because it doesn't give me any points, so why would I? But I want to keep it open so I can have that credit history, right? Well, sure enough, every single year, even multiple times a year, they try to close the credit card because I'm not using it. So I have to just buy a few things here and there to keep it going and keep that credit history. And recently, they tried to kind of sneak one by me, and they said that they sent me a reminder to use the card or they'd close the account. Never got one, and I just got a message that said the account was closed. So I had to fight it, and I did. I contacted the bank. We had to go back and forth. We had to fight about a lot of stuff, but eventually we got the card opened back up. I retained all that history, but that's something that you have to be on top of and you have to keep an eye on to make sure that these banks don't take advantage of you to lower your credit score. So this is an example of credit history length. The longer your accounts are open, the better. Shutting down old cards can shorten your average credit history, which would be another negative factor. So the truth here is, unless the card has an extremely high annual fee and you really don't want to pay it, keeping older accounts open helps your score more than closing them. Now, on to lie number 4. Your income affects your credit score. This one sounds logical, but it's definitely a myth. Banks like to imply that having a higher income makes you more creditworthy, but your salary or your job title has no direct impact on your credit score. Credit scores are based on 5 factors: payment history, amounts owed, length of credit history, new credit, and your credit mix. None of those include income. Of course, income does matter when lenders evaluate your ability to repay, but that's separate from the actual score. And I'm curious, have you ever heard one of these lies? Drop your experience in the comments below. I'd love to hear your story. This final one, the idea that any debt automatically hurts your score, is simply not true. In fact, a healthy mix of credit types like credit cards, installment loans, and a mortgage can improve your score. What matters is how you manage the debt. Paying on time, keeping balances low, and not opening too many new accounts at once is what boosts your credit. Having a mortgage or student loan that you consistently pay on time can actually be a very positive factor. So the truth is, debt itself isn't the enemy. Mismanaged debt is. Banks profit when people misuse credit, and that's why they're happy to let myths about all debt being bad continue. And now our final section, strategies. I want to talk about actionable steps you can take starting today to maximize your credit. Some of these key strategies include the most important: pay on time, always. This is the biggest driver. This accounts for around 35% of your credit score. So do what you have to. Set calendar reminders, automated payments, have a friend remind you, whatever you have to do to make your payments on time. And next, lower your credit utilization. You want to aim for less than 30% of your max amount of credit being used, and 10% is actually the sweet spot. And like we spoke about, keep older accounts open. Don't close accounts unless they cost too much. Use them occasionally to keep them active. And be sure to limit new credit applications, because each hard inquiry can shave a few points here and there. So only apply when needed. And build a healthy credit mix. Over time, responsibly add installment credit. You can add an auto loan, personal loan, a mortgage, but just don't open too many at once. Be sure to space them out. And be sure to use free credit report tools like Experian Report to monitor your credit and dispute errors. Fight back. Make sure you dispute all errors on your report. The good news is you do not have to do this by yourself. This is where a financial planner can really help. They can help create custom credit improvement roadmap. So you have a step-by-step guide, and they can help monitor the progress over the months and years. You can coordinate your credit goals with your other financial goals. So have it in line with your savings goals, investing, and your debt management goals. They can help provide accountability with regular check-ins and course correction, and prevent you from falling into traps. Working with a planner doesn't mean they do your credit for you, but they can help you stay disciplined, avoid common pitfalls, and see progress faster than you could alone. If you enjoyed this video, we'd really appreciate a like and subscribe so we can build this channel and reach more people with this important information. And please stay connected with us. Our socials are listed in the description below. Thanks, and we'll see you next time.